Okay, good morning. So today we're starting out with the question. There is a handout. If you're online, we're offered it. Amir can also paste in the link if you need it. If you're in here, it's at the door. And this is the handout for today and Wednesday. Starting with the question, so in Learning Catalytics, which of the accounts below is usually not a liability? So when you're looking for something that's not a liability, I guess I should, okay. Good, majority of you are right. But not a liability, first thing you can do is anything that's just payable in it, that's a really big clue that that's a liability. So it can't be A and C. Unearned revenue is when people pay us money before we actually perform the service, like concerts, and so that's a liability. Until we perform the service or deliver the goods, that's a liability. So the answer in this first one is investment in bonds. Investment in bonds is when we buy bonds from companies as an investment. So that is an asset. So that's why the answer for 18 is investment in bonds is an asset. Okay, so that'll stay open for a few minutes, and we're going to start with some feedback. So what I did is last Wednesday, I sent out the question. I got some interesting feedback. So I have 4 things that I picked out as themes or interesting comments. So first one, somebody asked, what is par value? When we talked about par value last week, we're going to talk about it more today. But in a nutshell, par value is a legal amount. It doesn't mean anything other than that. Companies can't sell their stock for less than par value. So that's pretty much it. There's really not anything else to it. We use par value in the accounting for it. Par value is in a corporation's charter with the state in which they incorporate, but we don't do anything else with it. So par value really means nothing except you need it for the accounting purposes. Okay, then someone asked, what's the reason for amortization? So last week we talked about bonds where the bond market, the bond coupon rate, the interest the bond pays is less or more different than the market rate. And we have to issue a bond at a premium or discount to make people want to buy our bond. So that premium or discount, it represents interest. And rather than take all the interest in the period in which we issue the bond, we spread it over the life of the bond. So with amortization, we spread that interest out over the life of the bond. The bond will typically be anywhere from 3 years to 30 years in life, so that premium or discount, we want to spread it over the whole life because this bond we're paying interest on, we're servicing it over 30 years potentially, so we want to spread it out. Okay, so those were 2 questions, and saw it a couple times from a couple people. So there, I appreciate the feedback. And then we come to another piece of feedback that I thought about. Actually, this was the piece of feedback that I thought about the most, and I really settled yesterday on what I was going to do about it. Okay, so this is somebody's feedback. I pasted it in exactly like this person wrote it. I feel like we take way too much time on the Learning Catalytics questions. We spend so much time repeating the answer, and people still don't get it right, and to me, that is a waste of my time. So I thought about it, and I thought, okay, there's something there. So when I thought about how to do this, but I didn't want to say, well, we'll just have it open 5 seconds and we'll be done. When I do the Learning Catalytics questions, first of all, there's 2 types of weighting that go on here, first of all, explaining further. When I put up Learning Catalytics questions, my point is not to test your knowledge. This is not like a test in class every day. Do you understand this? This is for a couple purposes. Number 1, for me to gauge how the class is understanding. You know, are people getting this or are they not? Also, when I put up questions, there's oftentimes that I put up questions that I absolutely know that most people won't get it right when I put it up the first time. But then I use that question as a springboard to talk our way into that question, and I consider talking part of the class instruction. So the fact that I'm talking about the question and explaining it, that's part of the class. So that kind of waiting, when I'm waiting for people to get it because I'm explaining it, to me that's a very good thing, and I don't want to do anything differently there. And of course, we all answer at different rates and different paces, and some people will answer very fast and some people will take a little bit longer. So know that I'm watching that too. I can see how many have answered and how many have not yet answered, so I can get a gauge for that. And then when I see a bunch, there's green and red bars for me, and as I watch that, I can get a sense of are we understanding it or not and talk my way to the right answer. Okay, so that's very good. I'm not going to change that, and I don't think that's what the person was referring to. What I think this person was referring to is after I give my answer, after I give the answer. So I've just talked about it. I've spelled it out. I said this is the answer, or gone so close there. That's what the person I believe is talking about, and I think that that is a valid point. Point well taken. Thank you for the feedback. So in response to this, what I want to do is, after I've given the answer, I agree. Why are we waiting around for that? I've given the answer. So after this, the new rule is, on those ones where I've given the answer, after I give the answer, I'm going to close Learning Catalytics 5 seconds after I give the answer. So I'll tell you the 5 seconds are starting, and then I'm going to close it. So I'm not talking about putting up the question, leaving it there for 5 seconds and closing it. I'm talking about when we get to that point where I've talked through it, then 5 seconds and we're moving on. Now it may be a few more seconds than 5 seconds because there is a lag between when I say something and the audio showing up online. It tends to be a few second lag there. So if you're timing me in class here, it'll be a little bit longer if you're in the face-to-face class. So this rule, we just instituted it at my 7:45 class this morning. Went very well. And again, I don't anticipate changing the way I talk about questions, but what we are going to tighten up is once I've given the answer, we're going to close it and move on. So just a heads up there that we will be doing this today. So thank you for the feedback to the person that issued that comment. And again, it was something I thought about a lot over the last 4 or 5 days or so. Okay, and I hope that we'll address it when we talk about it. So, okay, one more. This one's really quick. Someone wrote, there was some more in the middle there, but I cut it out. Will you please tell me what app you use to create those points? Thank you in advance. Okay, so I was messing around one day, and I discovered this app. It's actually called WordFlag, and it's very easy to use, and I just add some visual interest. So that's what I'm doing. And so if you want to know, there's my plug for WordFlag. I have no connection to it whatsoever. It was a free app one day. I read about it, and it's kind of fun. So, so there you go. Okay, so moving on. So we have a handout for today. It's the some of the more detailed PowerPoints. And we are going to start stockholders' equity. So what we've done this semester is we started out talking about the accounting cycle, and we went through, that was chapters 1, 2, and 3, and then we've gone through the balance sheet. We start with assets. Last week we did liabilities. This week we're doing stockholders' equity. So that's what this week's about. But before we get into this, it must be announcement day. I have a few more announcements. First of all, our Chapter 10 homework is due this Saturday. It will not be overly burdensome. This isn't one of those huge, long ones. And I wanted to mention the extra credit project. I can see several of you are working on it already. You've seen it there and kind of explored it. There is an extra credit project available in this class. It is in My Accounting Lab. It's tight. It's under homework. For details about the extra credit homework, go to Blackboard. On the left-hand side menu, the links on the left, there's extra credit project details there. But here's the high points. If you do the extra credit project, which is a project in My Accounting Lab, it will add 2% to your final grade if you complete it and comply with all the requirements. So if you end up the class with an 89% in the class and you do the extra credit, your course grade will go up to 91. So it's a pretty big jump because it's in your overall grade. It's in My Accounting Lab under homework. It's due by Saturday, May 7th, 11 p.m. There are no extensions. There's no submit it late. It's also not something you're going to do in an hour. This is a 2% bump to your grade, so it's pretty significant. It deals with chapters 1, 2, and 3. So it's an overview of the accounting cycle. The reason this project came about was because the accounting cycle is extremely important if you're an accounting major. The accounting cycle is that that cycle of having transactions happen. We analyze them, we post them to the journal entries, we put the journal entries in the accounts, and then we make financial statements, kind of in a nutshell. But that's very important if you're an accounting major. And I wanted to say to the accounting majors, you're required to do that, but that would be silly because you don't want to burden one group over another group. So what I decided to do is just make it optional for everyone as an extra credit assignment, and know that everyone, in my opinion, everyone should do it. I would always do extra credit just to make sure my grade was as high as it possibly could be. So you have to complete all 10 steps in it, and you have to get a score of at least 90% on each step. And you have to do one step before you go to the next. And again, this isn't something you're going to do May 7th. You want to get started on it. There is no partial credit. It's not like you could do half of it and get half the credit. The accounting cycle is an entire cycle, and I want you to see each step of that. So you either get 0 extra credit or 2%, but you need to meet the terms. You need the 90% on each step. Okay. One other note about the extra credit. The extra credit is housed in My Accounting Lab. It looks like a homework assignment. Until the end of the semester, it will continue to impact your grade. So if you started and you have a score of 10% on it, if you start it, it will drop, it will pull your overall score down. But when you finish it, I cannot take it out of My Accounting Lab until after it's due. It's just a technical thing. They won't let me assign something and say, oh, this doesn't count for your grade. So everything counts. So what's going to happen is after the due date of May 7th, I'll remove that from My Accounting Lab, and then you will actually never see the 2% in My Accounting Lab. I do it right before I put grades in Flashline. So if you're on my list of people that earn the 2%, I add 2% to your grade. Okay? But I would encourage you to do the extra credit project, and if you need assistance with it, obviously work it through. It's got help system there. If you need further assistance, you can email me, and actually Amir is the one who helps, does that. But email me. I'll be the gatekeeper here. Okay, so then I think now we are to the end of our announcements, and we're going to dig into the material for today. So we're talking about corporations. We're talking about stockholders' equity in this chapter. Stockholders' equity means you're a corporation. That's the only way you can have stockholders' equity. So first we start with advantages of a corporation. This is in your handout that I gave. So we've got the advantages of a corporation. Basically, corporations have stock so that they can easily raise more capital. It's easy for them to issue stock. They get cash in. It's easy to transfer ownership. You buy and sell stock, and limited liability of corporations. The disadvantages of a corporation, the two biggies are double taxation of corporations. Corporations are a legal entity, so they pay taxes. They also, when they issue dividends to shareholders, shareholders pay tax on the dividends. So that's why we say there's double taxation. There's also a lot of government regulation of corporations because the government says these are legal entities, so we're going to protect the shareholders, so there's a lot of government regulation. Okay, so when companies issue stocks, there's two classes of stocks they can have. They can have common and preferred. Common stock, every single corporation has to have common stock. Everybody has common stock. Every corporation has common stock. That's what it's called, common stock. Some corporations will have preferred stock. Preferred stock, we're going to talk about some of the characteristics coming up here in a moment. But preferred stock, not that many companies have it, but enough that we need to talk about what it is. So common stock, every company has common stock. Some companies have preferred stock. And we'll talk about preferred stock in just a few minutes here. Next on your handout is a list of stockholder rights, and this is just vocabulary for you. Your stockholders' rights. Stockholders have the right to vote on matters that come before the stockholders, so they get proxies and they vote on certain things. stockholders have the right to receive their proportionate share of a dividend. So you can't just say, oh, we're going to pay dividends to these stockholders and not these other ones. Everyone gets treated the same within a class. If liquidated, you have a share to the right of the liquidation results after liabilities. Liabilities, if you go belly up, if you go bankrupt, your liabilities are paid first, all your debts are paid first. If there's any money left over, then that money will go to the shareholders. And then preemption, you can keep your same proportionate share of ownership in the corporation. Okay, so vocabulary terms. Now what I'm going to do is I want to talk about preferred stock briefly, okay? And we have terminology for preferred stock. So what I thought I'd do is I'd bring a real-life company in. It's very few companies have preferred stock. So a lot of companies have it listed on their books, but they don't have any, like Amazon. Amazon has preferred stock listed in its stockholders' equity section, so it can issue preferred stock. It just never has. So what I did is I picked this company, Cedar Realty Trust. And what they do is they have shopping malls or shopping centers in 69 locations, and they go from Washington, D.C. to Boston. Cedar Realty Trust is publicly held, and so all this information that I'm getting came from their filings with the SEC. It has 65 properties, 899 tenants. It goes from Connecticut, Maryland, Pennsylvania, etc. Their revenue is generated from rental income, and their two biggest tenants are Dollar Tree and Giant Foods. So they operate these shopping centers. And the reason I picked them is because they have preferred stock in addition to common stock. All this information I'm giving you here came from their Form 10-K. And the reason a Form 10-K would be important to you is if you're going to go work for a company, one of the best things you can do is download their Form 10-K if they're publicly held. Every publicly held company that's traded on a stock market has to file Form 10-K with the SEC, the Securities Exchange Commission. And this document, typically they're 100 pages long, lots of words, but there's so much good stuff in there. The financial statements are in there, kind of in the middle, towards the back, but there's a lot of information about what the company's done in the past and what its plans are in the future. But I'm using Cedar Realty Trust here, and their shareholders' equity, they have preferred stock. And preferred stock, it tells us this is part of the balance sheet, it tells us it has a 1 cent par value, how many shares are authorized, the liquidation value, and issued and outstanding. So we're going to go through some of that because then we're going to the note in the financial statement. So that was the balance sheet. It gave us that information. Then we go a few pages later and it talks about the numbers in the financial statements. Whenever you read financial statements, if you look at a company, it is not very helpful just to look at the numbers. You need to look at the notes that go with it, and that's what we're looking at here. So this is Cedar Realty Trust notes to their financial statement about preferred stock. First thing, so this is all just talking about the vocabulary, and you have this paragraph in the handout I gave you. The 7.25%. Preferred stock kind of looks like debt in that it has a percentage, and that percentage is what it pays if a dividend is declared on the par value. So this stock right here will always pay, if a dividend is declared, and we'll talk about that in a moment, but if a dividend is paid, it will pay 7.25% of the $25 share price they're given. So it doesn't matter. If the company declares a dividend, these shareholders will get 7.25% of $25. That's their dividend. Now, common shareholders, on the other hand, common shareholders can get more or less or anything. So preferred stock is kind of like debt in that we're getting a percentage of the par value. Okay, so that's the percent. So when you see stock that has a percent on it, right away it tells you it's preferred stock. Okay, next word, redeemable. Redeemable means that if I've bought this preferred stock it tells me it's redeemable, which means I can take it to the company and I can say, I want to redeem this. And it's telling me right here that the company has the option to redeem it. So it can be redeemable from my standpoint, but the company it says they have the option to redeem it. And the company can make this decision after May 22nd, 2017 to pay $25 per share plus any unpaid and distributions. Okay. So then we have liquidation preference of $25. What does that mean? That means if Cedar Realty Trust declares bankruptcy, after it pays all of its debts, if there's any money left over, the preferred shareholders get $25 a share before any common stockholders get paid. And that's where the word preferred comes in play. Preferred means that they get preferred status with respect to common stockholders because they will get paid first before the common shareholders do if it liquidates. Okay, and it says it's not convertible. Preferred stock can be convertible, and what convertible means is if it was convertible, the preferred shareholder would be able to take their share of preferred stock and convert it into common stock at some future date. And the reason the reason a preferred shareholder might want to do that, preferred stock pays the same amount over and over and over. Preferred stock does not fluctuate in market value. So preferred stock, if dividends are declared, provides a steady stream of income. Just the same. Now common stock, there's a lot of fluctuation. It can go down, up, down, up. You can get no dividends, or you can get really small dividends or really big dividends. But common stock, what we're looking for in common stock is the value of the firm to increase so the common stock goes up. So common stock, there's more risk, but there's more potential return. Preferred stock's just this steady stream if the dividends are paid, and we'll talk about that. A company is never obligated to declare a dividend, and we'll talk about those dates coming up. Okay, so issuance of stock. So now we're moving on to common stock. We're not going to issue preferred stock. We're going to look at the issuance of stock. Okay, so what happens when we issue stock? So again, Cedar Realty Trust has common stock 6-cent par value, and in the notes to their 2015 Form 10-K, it said that they issued 5,750,000 shares of common stock and realized proceeds of $4.19 million. Okay, so there's some rounding going on here. Let's assume the market price on the date of sale is $7.29 per share. We're at the top of page 2 in your handout, top right. Okay, and also the par value, just reiterating, is 6 cents per share. So market price is $7.29. Par value is a legal amount. We can't sell it for less than par value. That's why companies set them ridiculously low, like 1 cent, half a cent, in this case 6 cents. So they could never sell their shares for less than 6 cents a share. Other than that, it doesn't mean much. We use them in accounting. So we have 6 cents for par value. $7.29 is what they sold it for. So we're going to do the journal entry. Again, if you do the math, there is some rounding built in here. I just fixed the numbers so they worked out better. Issue common stock. So when we issue common stock, you have this journal entry in the handout. It's on the middle left on page 2. And what we're going to do here, when we issue stock, we issue it for the market price. So we'll take the market price times the number of shares. That's our cash. So cash is an asset, and assets increase when we issue stock, right? Because we're getting cash in. Okay, next up, common stock. Common stock, to get our common stock amount, it's always the par value times the number of shares. Because common stock is a legal amount. So we put the par value in common stock. And then finally, paid-in capital. Paid-in capital is this catch-all that says, okay, anything in excess of par, we're going to put in here. So I have it listed as paid-in capital, so we're going to take the difference between our debit and our credit, basically. The difference between the market price and the par value per share times the number of shares is how that works out to be. So I can calculate as taking the difference between our debit and credit, but if I wanted to, I could take the difference in market price minus the par value and multiply by the number of shares. Okay, now that paid-in capital, you may want to make a note, paid-in capital can actually be called, and its official name in this case would be paid-in capital in excess of par value common stock. Really long. Paid-in capital is the big takeaway there. Paid-in capital, sometimes it's called additional paid-in capital. But the paid-in capital is what you're looking for. Okay, so something to know, because you're definitely going to have a question on this today. Issuing stock causes both assets and equity to increase. Okay, issuing stock causes both assets and equity to increase. And this makes sense, right? Because when we issue stock, people give us money. So cash goes up, and when we issue stock, our equity goes up as well. So we have cash going up, assets going up, and equity going up. So this is key. Okay, next up now. Okay, so our next question, I'll read it and then I'll put this up. When 100 shares of $1 par value common stock are issued at $25 per share. So par value is $1. When market price is $25. Paid-in capital in excess of par value common stock. See where I said the title can be really long? Just paid-in capital will what? Okay, so I'm asking about just the paid-in capital. To answer this question, it would be that journal entry we just did for Cedar Realty when they issued stock, same thing. So put this out there. Yes, the answers are coming in. Great. Okay, the key thing on here when we look at this, okay, 100 shares of $1 par value. So let's think about this. Our par value is $1. And so keep these two things in mind. Par value is $1 and our market price is $25. So just going back to that journal entry that we had here, okay, cash will go up by the amount of the market price, right? The $25 times 100 shares, which is $2,500. And then our next entry, common stock. Common stock goes up by the par value, so it'll go up by $1 a share times 100. Okay, and then this paid-in capital, which is what the question's asking about. The question is asking about paid-in capital. What happens to it? Well, paid-in capital always gets the difference between the market value and the par value. So our market value was $25. Our par value was $1. So we had $24, right? $24 per share. We issued 100 shares. So what's going to be happening here is our paid-in capital is going to increase by $24 times 100 shares. So when we're going back here, okay, this paid-in capital, when we talk about that, the paid-in capital, okay, will be increasing by the difference between the market value and the par value, the $24 per share times 100 shares, because we didn't just issue one share, we issued 100 shares. So we have 100 shares. So what we're going to be doing there is that is going to be increasing by 2,400, right? Because that's where we got the 24, the difference between 25 and 1, the 24 times 100. And now we are into the 5-second rule here. increased 2,400. Okay, now I've got a couple of these that too many words to fit in a fancy slide. So some of the rules, because we're going to have a couple questions coming up on this, okay? We record common stock issued for assets other than cash at the fair market value of the assets. What this is saying is if we issue stock, if a shareholder, this happens a lot when you start a company. When you first start a company, shareholders don't, the founding members don't necessarily put cash in it. What they might do is instead they'd say, okay, I'm going to join the corporation and I'm going to put in this delivery van that I have. That'll be my contribution. So when we get a contribution from a shareholder, when they purchase stock with something other than cash, we have to value that at the fair market value of the asset. So that's the key here, is it's the fair market value of the assets. Okay, so the fair market value, if I contributed the van, it's going to be recorded at the fair market value of the van. If I contribute a building, it's going to be valued, the stock will be valued at the fair market value of the building. We're going to have questions coming up on this, too, and I'll have two of them, I believe. But always know that we value it at the fair market value of the assets. So an example, it's hard to find this because these are proprietary, not typically published. But we can have a corporation issued, this example's in your handout, issued 15,000 shares of its $1 common stock for equipment with a fair value of $4,000 or market value of $4,000 and a building with a market value of $120,000. So what we see here is equipment at its fair market value, buildings at its fair market value, okay? The common stock is at the par value, okay, so the $1 par value, and then paid in capital gets everything else, okay, the difference between our debits and our credits. So we value the equipment and the building. Whatever we're getting is valued at fair market value, and that's what we use for doing the recording. Okay, now very closely related to the last thing that I said was we can also issue common stock for services. Okay, and when we have services in exchange for stock, we're doing the fair market value of the services. This frequently happens with attorneys and startups. When you start up a company, there's a lot of legal matters that can come into play, especially if you're going to be publicly held. You have to do a lot of things. So oftentimes, there are attorneys that specialize in this, where they say, I will do the legal services for your corporation startup, and in exchange, I know you don't have a lot of cash, so in exchange for my services, you can issue me stock. And that's what happens. So I have an example here, and we have a company that engaged an attorney. The attorney billed the corporation $25,000 for services and says, okay, you can give me stock in exchange. So we record the entry, we record the legal expense at $25,000 at the fair market value of the services. So the market price of the stock never enters into anything. When we're getting stock in return for services or assets, everything is valued at their fair market value, the assets, either the assets or the services we got, valued at their fair market value. Okay, now, so we have a question coming up. Okay, if stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? The asset recorded on the books of the corporation at. So we issued stock for a van. What should we record that van on the books for? Okay, when you're answering this one, so we're saying if stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? This would go back to this rule right here. We record common stock for issued other than cash at the fair market value of the assets. So fair market value is what we're valuing these things at. Okay, and I believe that will invoke the 5-second rule now because I just gave you the answer. Okay, so if stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at, I just gave it to you, so we're into our 5 seconds. Okay, it is fair market value. Okay, so fair market value. So when we have services in exchange or assets in exchange for stock, it's going to be valued fair market value. Okay, now one more question. This one looks overwhelmingly long, but it's not bad. You do not have to do any calculation with this one. There is no math involved. Wolverine Corporation issued 5,000 shares of its $5 par value common stock in payment for attorney services of $40,000. The fair market value of this legal service is $40,000. That's what that first sentence is saying. Wolverine stock has been traded at $20 a share. This transaction would include what? Okay. And again, I told you didn't have to do any math. So if you don't have to do any math, you know you can eliminate A and C. Okay. You've got to pick an answer with $40,000 in it. So when you're doing this, we have $40,000 payment for attorney services of $40,000. That's the fair market value for the attorney services. When we have attorney services, that is actually called legal expense. So you would debit legal expense is what this comes down to. And I am in my 5-second rule here. After I deliver it, I've answered. Okay, now we're in our 5-second response. Really? 97% correct? Okay. There we go. Okay, next up, still talking about common stock. There's a couple numbers that you need to know. Okay, and you have this in the lower right-hand corner of page 2 of the handout. There's authorized, when we talk about the number of shares, there's 3 numbers, and these are vocabulary terms you need to know. Authorized, it's the maximum we can ever issue. That's in our original charter. That is governed by state law. It's whatever you put in your charter. You can never issue more than that. So companies will typically make this a huge number, like 50 billion or something, some ridiculously huge number, because to issue more than that, you have to go back and revise your charter and refile, so this isn't something you want to do. So that's a big number. Next up, issued shares. Issued shares are the number that we've issued. So we've issued this stock and we've gotten money from the market. So these shares have gone out to shareholders. Then the next number is outstanding. And these are the number of shares that are actually in the hands of shareholders. It will be a lesser number, equal to or less than issued. How do we have outstanding shares be different than issued? We can buy our own stock back. We buy our own stock back. That's called treasury stock. That's what we're coming up to in the next minute, is we're going into a section on treasury stock. Treasury stock is our own stock that we've purchased back. We cannot own ourselves, so when we buy shares of stock back, they're no longer outstanding. So we have authorized shares, which is the most we can ever issue. Issued shares are how many we've actually issued, and then outstanding is what's out there in shareholders that we haven't bought back. We can buy back our stock for a variety of reasons. Okay, so again, I want to emphasize that outstanding shares are the number of shares actually owned by shareholders. Our own stock that we've bought back is not outstanding. Because we do not pay ourselves dividends, we cannot own ourselves. So when we buy it back, it goes into this item called treasury stock, which we're getting to. Okay, so outstanding shares are the number of shares actually owned by shareholders. So that brings us to treasury stock. Treasury stock is our own stock that we've bought back. And you have this slide, top of page 3. Treasury stock are issued shares that we've bought back, that we've reacquired. That just means we bought back. Treasury stock is considered a contra equity account, has a debit balance. It reduces our equity accounts. Okay, so a couple of big things out of there. We've got a lot of big things, it seems like, with treasury stock. Treasury stock is a contra equity account. Contra equity. It reduces equity. It's the opposite of the rest of the equity accounts. So the rest of the equity accounts have normal credit balances. This has a normal debit balance, but it's contra equity. We might see it as contra stockholders equity, means the same thing. I just shortened it up here. Contra equity, contra stockholders equity. Okay, now also need to know, treasury stock is recorded at cost. Okay, it's the simplest thing. When we buy treasury stock, easy. We just take what we got, put it in cash, take it out, put it in treasury stock, take it out of cash, put it in treasury stock. That's it. We don't mess around with par value. We don't mess around with the original cost, anything like that. It's just recorded at cost. Okay, now we're going to talk about Caterpillar. And Caterpillar is publicly held. This is a picture, I took it a couple weeks ago in my neighborhood, you know, before all the snow. And Caterpillar purchased $28 million of its own stock. The stock symbol for Caterpillar is CAT. $73.16 per share, September 1st, 2015. This is true. I have revised some of the numbers. It actually happened over several dates. I just made it all one date, and I rounded the numbers to make it easier to deal with in class here. But this happened otherwise. Otherwise, it's all true except for the number and the date. But so when it purchased its own stock, what it did is Caterpillar would have debited treasury stock, which is a contra equity account, for the cost. And the cost is 28 million shares times $73.16 per share. So they would have debited treasury stock and credited cash. So what's happening there is we would reduce equity with the treasury stock and reduce assets. So whenever we purchase our own stock back, it will reduce equity and reduce assets because we're using an asset, cash, to buy the treasury stock. So then when you look at Caterpillar's balance sheet, this is the balance sheet as of the end of December 2015. You see common stocks there for 815, this is in millions. Paid in capital in excess of par, $4 billion. And then treasury stock. And we see treasury stock will always be shown as a negative. Okay. So treasury stock is always a deduction from equity. It's a contra equity account, so it's going to be shown as a deduction from equity. Okay, and then other things on there. So treasury stock shows up. You have to put brackets around treasury stock. Absolutely have to. that's, I guess, a heads up on the homework too. Treasury stock is a negative. So when you put it in a balance sheet, I cannot remember if you have this exact situation, but that's where you would do it. So negative, okay. Now, what I'm going to do is I'm going to talk about a little thing. So we said that companies buy back treasury stock for a variety of reasons. And some of the reasons are quite good. Sometimes the companies think our stock is seriously undervalued, we're going to buy it back now low, and then we're going to resell it high later, and that'll help our equity section. So that's one reason. Companies may need their shares of stock to put into an employee incentive program. They might be issuing shares as part of either pension plan or to incentivize employees. Companies might want to buy their stock back because they think they're going to have a takeover and they want to get some of the shares of stock off the market. So there's a lot of reasons. Now there's also reasons that maybe are not as good. Okay. Now this is Caterpillar. And Caterpillar, what I'm going to do is I'm going to show you, this is for 2012, December 31st, 2012, 13, 14. So 3 years in a row. And Caterpillar has an incentive bonus, performance bonus for its CEO. Okay? So this is the end of 2014, total revenue. We look at what happened to Caterpillar's total revenue. It went from $65 billion, I'm just rounding here, $65 billion in 2012, went to $55.6 billion in 2013 to $55 billion in 2014. So sales plummeted, right? That's a pretty big drop. It dropped from 2013 to 14. Then we put in operating costs, we come up with operating profit. Operating profit also went down. Caterpillar did not increase operating profit from 2012. It fell to 2013, and then it fell further in 2014. And then other items. So you basically get Caterpillar's bottom line for all 3 years went from $5.6 billion to $3.7 billion to $3.6 billion. So Caterpillar fell on every criteria here. So the analysts were looking at it going, boy, its sales tanked, net income tanked, operating profits tanked. And that's not surprising. Once your sales tank, everything else tanks too. I mean, it still has some profits, certainly, but not what they were 2 years ago. So they have a CEO, and their CEO sits on the board, and their CEO actually sits on their compensation design committee. So this committee designs his own performance bonus criteria. So and the board of directors went along with this, but so they designed his performance incentive program for 2014. He would get a bonus for great performance if earnings per share went up. Okay? So forget everything else falling. So when you look, should the CEO earn a performance bonus for 2014? So anyone looking at this would say no, and the analysts thought no, because they didn't do well. However, what Caterpillar CEO earned a hefty bonus for 2014. And the way they did it is their earnings per share. If you look at their earnings per share for 2013 to 2014, it increased. And you think, wow, every other criteria we've looked at has tanked, right? It's gone down, but earnings per share increased. And how is that possible? That's possible because the CEO, also sitting on the board, said, we're going to do a share buyback. So what happened is they bought back a lot of shares in 2014. So what it did is it made the earnings per share higher because there's fewer earnings per share. Let's get to this. Okay. Earnings per share is net income, basically net income divided by the number of shares. So there's only two ways for earnings per share to increase. For him to get his bonus, earnings per share had to increase. We had to have higher net income, which they clearly did not have. But the other way you could increase earnings per share is to decrease the number of shares, right? Because you're splitting it up fewer ways. So this CEO said, okay, we're going to the market in 2014 and we're buying back all these shares. So they were able to increase their earnings per share. If you instead did the earnings per share, so that if you did the earnings per share If they had not bought back the shares, if they had kept their same number of shares all 3 years, their earnings per share would have fallen from 2013 to 2014 from $5.81 to $5.66 if they had not bought back shares during any of those years. This is not uncommon for a company to do. So when you look at earnings per share from a company, you kind of have to look at what's happening with treasury stock because they can manipulate their earnings per share. In this case, the CEO was on the compensation committee, helped design his own compensation. So what's easier, do you think, as a CEO, to increase net income or just go out and buy your own shares back? Okay, so that's what happened, and that's why it's important to understand different measures. You know, what's really happening here? He got a hefty bonus because earnings per share went up, but if you look at the other things behind them, they all went down. So there's just a story about treasury stocks. Okay, so a couple takeaways. When we buy and sell treasury stock, we have no gains or losses on treasury stock. So no gains or losses on treasury stock. On our own, treasury stock is always our own stock. Okay, so no gains or losses on treasury stock. Okay. Okay, now, buying, this is important. We're going to have a question coming up on this one specifically. Buying treasury stock causes both assets and equity to decrease. Buying treasury stock causes both assets and equity to decrease. I didn't notice it till I got into class this morning, so obviously we're playing with these images. If you look carefully, this background says, love you, love you, love you. Next, I'll be doing hearts and flowers. Okay. Buying treasury stock causes both assets and equity to decrease. When we saw this back a ways, let me see. On your handout, the reason that is, okay, so back to Caterpillar where we saw that the treasury stock purchase would decrease equity, cash is decreased, it's an asset. So remember that because this is coming up here. Okay, back to the love you slide. Buying treasury stock causes both assets and equity to decrease. So you think about what Caterpillar was doing. It was buying back all this treasury stock, reducing its assets because it was paying out cash and causing its equity to decrease as well. But the CEO got a bonus. So I guess that was the important part. Okay, so we're going to have another question here. And the question, the purchase of treasury stock by a corporation increases total assets and stockholders' equity. Okay. The word to pay attention to here when determining if this is true or false, read it carefully. The word to pay attention to is increase. When we purchase treasury stock, does that increase treasury stock equity and increase assets as well? Okay, we just had a slide on this, but I also have a hint. So when we purchase treasury stock, what we're doing is we're debiting treasury stock, we're crediting cash. And so this comment, this true false says, does this transaction I've got listed here, does that increase total assets and stockholders' equity? And the question I would ask you to answer this is just pick one, pick cash. In this situation, if we purchase our own stock back with cash, is cash increasing? We're going out, we're spending cash, we're giving cash away, right? We're getting our own stock back, but we're spending cash. When we do that, cash will decrease. So now I can go back to my statement here. The purchase of treasury stock by a corporation increases total assets. It absolutely cannot increase total assets. It's going to decrease it because we're spending cash. So cash decreases when a company buys its own stock back. Okay, so total assets are going down, so this question fails on that level. So it would have to be false, and we are into our 5 seconds. Oh, once again, see, I get so excited here. Isn't it up? We're good, right? Okay. Okay, so false because our cash decreases, so does equity. Okay, so now another one here. Okay, the purchase of treasury stock has the same effect as issuing stock. So is purchasing our own stock the same as issuing our own stock? The same effect on assets, liabilities, and equity. Is that true or false? Okay, the purchase of treasury stock has the same effect as issuing stock right now. Pretty good. But let me give you a couple hints in case you need help here. The first hint, if we issue treasury stock, which is the first part of that sentence, if we issue treasury stock, we're getting treasury stock in and we're spending cash, right? So there's one transaction. The other one is comparing to if we issue stock. So if we issue stock, we're selling stock, people are giving us money. So just are those two transactions exactly the same? Do they have the same impact? And the answer has to be no, because in one, you're getting cash. The other one, well, in number one, you're spending cash. In number two, you're getting cash. So issuing stock and buying back treasury stock are exactly opposite of each other. So we have made it to our 5 seconds starting now. Okay, so our treasury stock is going to be, issuing stock is the exact opposite of purchasing stock, right? One, people are giving us money, the other one, we're giving people money. So they're exactly opposite. That's why treasury stock is shown as a negative on our balance sheet. Okay, I have reached the end of what I want to do today. What? One more? Oh, Amir tells me we have one more, so it's your fault. Throwing you under the bus. Anyways, okay. He says he wants to be fair. Oh, well. Yeah, you probably want the same credit as the other class. Treasury stock is an equity account. Okay. Oh, whoops. I corrected this one wrong. Hold on. Read what's on your, here. See what I did? What? They're complaining about you? As well they should. No. Just kidding. Okay. Actually, this one isn't bad. Okay. Now that I've added to the confusion, treasury stock is a contra equity account. I'm going to give you the answer because I contributed to the confusion there. That is true. It is a contra equity account, so you need to answer true. Okay? We're into our 5 seconds. Okay. And then, okay, so now I can finish what I was starting to say. Okay. You're fine, right? You don't want to do any more? Okay. Okay. Since Amir's happy now, we'll be done. So we're going to end up here. If you have any questions or comments for me, go ahead and answer the question now. It is optional, as always. And that's what we're doing today. We will pick up here. We will use the same handout on Wednesday. So we'll see you on Wednesday.